Hello, people. We're waiting for people to join to come on to the call. We'll start in a moment. Okay, we're going to start. Good morning. I hope we're all comfortable. Welcome to our Academies update webinar called Surviving Turbulent Times, which is presented by PrimeGlobal firms, primarily presented by PrimeGlobal firms. We launched this webinar last year for the first time, which went down extremely well, and since then have built and streamlined that on that format based on that experience. And we're extremely excited to be presenting on the topics that we have lined up today. All but one of the speakers today come from PrimeGlobal, which I have to say is our award-winning association of independent accounting firms. As Academy auditors and accountants, we meet as a group regularly to consider issues and trends in the sector and to bring together the benefits of many minds and all of our experience. At last count, we acted for some 200 trusts and 1,100 schools, which is certainly significant. I think in England, there are 2,400 trusts and 10,000 schools. So we're broadly 10% of the sector represented in PrimeGlobal. Mainly though, from your point of view, from the point of view of our clients, it sets us up really well to advise, knowing that we're at the forefront and we're aware of how matters that are arising across the country. Anyway, individually, there are the characters that you can presenting today are the characters you can see on your screen. From the West Midlands, from CKCA, we have Mark Nichols. We have from the South Coast, from Carpenter Box, we have Robin Evans. From the Southwest, Westcott, David Wright. Also from the Southwest, from Monaghan's, we have James Gare, and me from Larkin Gowan. We work in East Anglia. Also joining us from Westminster, no less, we're delighted to welcome the excellent Simon Oxenham. Some of you will know of him from Southend High School for Boys. I will introduce Simon properly when he speaks later. Can we have the next slide, please, Fran? We have a tech team called Fran who, as we go through, we will ask to change the slides. There are undoubtedly some massive financial issues facing pretty much all the sector at the moment. Finances are certainly somewhat of a challenge for everyone that I'm talking to. We've of course had big energy price rises. This seems to be perhaps a little more managed than 12 months ago, but it depends on your specific procurement arrangements. Big one is pay rises, of course. Again, we're all making assumptions in our budgeting that costs are going up without any certainty that there will be income to match. There's also the consolidation agenda with the potential change of government next year. That might take a new direction, and there are pressures and incentives to be more sustainable to help prevent climate change. Part of that might be through EVs, electric vehicles. All of these are threads that are running through what we're talking about. Also, of course, and you may have noticed, there are concerns around buildings. And attention particularly on safety for those who are in them. RAC has risen up the agenda in the past few months. On this seminar today, I know there are representatives of schools that have had closures in the last months. So I'm really excited that all of these topics run through the subjects that we're presenting on. We're covering the technical changes that you'd expect from us, but we've aimed to draw out where there's some real practical implications. Simon brings another perspective with some interesting, and I think his thought-provoking takes on reforms that are going on at the moment. So the topics are accounts directions and auditor framework. This of course links into the safety breaches and how schools present on those. Leases and electric vehicles, Robin and David's session on that. Leases is always an issue, but the electric, I mean, I'd be excited to get an electric vehicle. Electric vehicles are a useful way of sort of motivating staff, so that will be interesting. We will have a break of 10 minutes, then we'll come back with Simon's presentation on when numbers don't add up, which is a brief history of the funding crisis and looking forward to how you forecast in turbulent times, which is a very practical issue. We'll finish up talking about the trust handbook, really sort of going from that into practically James's take on how you might be managing risk. Please do ask questions as we go along. We may take them in the sessions, we may take them at the end. You can type them into the chat. They will be anonymous, and you type them into a box, and I think it's just super easy to do, says Fran. So, first subject, can we have the next slide, Fran? Accounts direction and auditors framework, which Mark and I are covering. I'm just going to introduce this. The way we're going to run this is I'm going to do an introduction, and then sort of Mark's going to do most of the presenting, but we're going to do it as a two-header. The Academy accounts direction. As for publishers together this year, the Academy accounts direction and the model Academy accounts and its guidance for external auditors, and these set out the framework for the financial statements for the year ended 31 August 2023, which boards are due to be approving by 31st December 2023. Obviously, in practice, they're going to be approving them at their November-December board meetings this year. I think this presentation aims to be relevant for anyone involved in the year-end process. It includes trustees and accounting officers and CFOs and their auditors. I think Mark, start off with, are changes significant, insignificant? How would you summarise them?
In terms of the Academy's accounts direction, obviously it forms the basis of how we're preparing the accounts. Changes are not significant generally. I think the ASFAs took the opportunity to clarify a few things. And a lot of the changes that are listed are clarifications or updates where things might have not been treated how they intended, but have just made it clearer, I suppose, in some of those changes.
And of course, sometimes quite often when they call something a clarification, it really means it's a change in practice. Yeah. But whatever they dressed it up as. Yeah. Can you tell us? Yeah. Can you just run through some of the main changes, the main updates, which indicated?
So I think on the slide there we've got the first one. What in particular was a clarification. So it was noted that where you've got an accounting officer, you may have previously listed something as an acting accounting officer, where you may have a head or a chief executive off sick, for example, and then someone's stepping in to sign the accounts at that point. Here, ESFA have clarified that there is no position of acting accounting officer, that the other person will come in as being the accounting officer. And
the other time, of course, the other time that happens, of course, it's not when the accounting officer is sick, but when a trust is being wound up, and transferred into another trust, isn't it? And that's
yeah, and I suppose that's significant in the fact that you have to notify SFA every time there is a change in accounting officer. You may not have seen it as a change where it was just acting accounting officer, but yeah.
The other case, it's not just accounting officer, it's key signatory, so it's directors. You need to have directors lined up. They mustn't all go away.
Yeah,
when you close the trust until they've signed off.
Yeah, the next point listed there, we've got narrative missing last year. Again, not really a change, but it just clarifies that some of the prior year updates to the 21-22 accounting direction weren't necessarily updated in the trustees report. Examples being organisational structure where you've got subsidiaries should make it clear about how conflicts of interest are managed there. So that probably wasn't dealt with that well last year, which is why they felt they've had to clarify that. Also, just generally rolling forward the report and not providing practical updates to what's happened in the Academy Trust that year. So again, not really a change, but just outlining something that they expect to see. And then the final point, again, not really a change in terms of irregularity. They've just highlighted some of the themes from their reviews, which I think we'll come on to shortly, Charles.
Yeah, I mean, kind of just on where the narrative is missing. I mean, one thing that it's easy to miss is that, and this links into what James is talking about at the end about risk management, is it's not just, you've got to just, there is a requirement to describe why you've chosen a particular internal scrutiny option, isn't it? And
Yeah.
that's, yeah, just show you've thought through that process.
Yeah, making clear why you're addressing those risks. Yeah, exactly.
And the theme about those emissions, I think, is that they tend to sit in the governance section. Now, if you can think back to what the accounts look like, you've got trustees report, you describe a load of things, and then you get to governance. And I think part of it is, well, by the time you get to governance, you're running out of energy. So,
yeah. Yeah, it's avoiding the use of standard wording, I suppose, where you're trying to copy the model accounts, and it's trying to explain more about what's actually happening in the trust. Yeah.
So yeah, and are we going to come on to the? Do you want to talk about the themes from the ESFA reviews?
Yeah. So I think we've got that on a few slides on.
Okay. Okay. So next slide, please.
Yeah. So as Giles mentioned, there's big risks with school building safety with the RAC at the moment. Ahead of that, the accounts directions outlined how that should go into the trustees report, the narrative reporting. So we've got principal risks and uncertainties section. So always needed to outline principal risks and uncertainties and how the trust's addressing those. The change this year, I suppose, is specifically to school building and safety, just to say that how those risks in terms of the trust estate managing it and keeping it safe are dealt with, what uncertainties there are. So if a school does have RAC, you would expect to see something included there as to a plan of how they're dealing with it. And then similarly on the value for money statement, in terms of how that is being managed, how the school is still ensuring they have value or getting value for money on that estates management process. Yeah.
Okay. And the reason we put these in yellow on these slides is because those are the new sections, aren't they?
Yeah. So in the model accounts, anything that is changed is highlighted yellow. There's not a lot of changes, so they are easily identifiable, but that just makes anything stand out. Given what we said previously, that some of last year's changes were not updated, it might be worth looking at the past 2 years to see what's yellow in both model accounts, make sure they're dealt with.
Yep. And there's another, and the next slide, please.
Yeah, so this is the accounting officer's statement that trusts are required to sign. And I think Simon, our keynote speaker, will have something interesting to say on this later as well. You can see the highlighted yellow bits there. So it's almost added in the estate safety and management sections to require someone to sign. So that, as opposed to the risks and uncertainty where we've got sort of things that we can tailor and shape for the trust, this is set in the accounts direction as standard wording. So that's a requirement to be included.
But again, yeah, as you say, Simon will talk about this, and there's standard wording and standard wording, isn't there? But the two previous slides are the previous slides very much about tailorable content, which allows you to explain your approach to managing this issue, which is so high profile, and which I'm sure people who are reading accounts will be taking notice of this year. So as part of your risk management, part of your sort of getting out the message,
exactly.
You certainly have highlighted. They're certainly highlighted where you can enter, and your auditors will be talking through these areas and highlighting them with you as part of the accounts preparation, I'm sure, whoever they are, even though there is no strict requirement for us to be auditing these sections.
Yeah, exactly.
Okay. Okay, shall we go to the next slide?
Yeah, so these are other changes that we've listed out that I suppose are not quite as significant. There's a clarification again on trustees' use of the direction. So I think it's people that are involved with preparation of the accounts. And it also, I suppose the change this year is that trustees are not expected to have a detailed knowledge of this, and should refer to CEOs where
ask
possible.
the CFO, it says, doesn't it? If you're not, yeah, ask the
Exactly.
CFO. You're not expected to know this chapter and verse, which I think, yeah.
Exactly. It's accounting officers, external auditors, people preparing the accounts generally. Yeah. And then I think there's the next point on concessionary loans, which I think that's clarifying some wording. It is in as an update, but it's clarifying some wording where there were some loans that weren't covered under the previous wording. Would you say, Giles?
Yeah, I think it was badly worded before.
Yeah.
It was the answer, because the point is technically, long-term loans you're expected under FRS 102, so it's about 2014-15, to discount, but of course we don't do discounting on long loans in academy accounts, and the reasons for that is because there's an exemption because they're a charity, but it wasn't. It was a technical update because it wasn't properly described in here.
Yeah.
Basically, it's clarifying Salix loans and other loans such as SIF loans or loans inherited on conversion with local authorities. There is no question that you should have to discount those and do those technical awkward calculations which are no benefit to anyone. So that's just cleaning that up. The next one, I think, material income sources, that's just, if you've got a list of income sources and the biggest number is other, you probably need to break down what is in other. That's what it's saying. It's just tailor. Think about the accounts. Don't just take the words out of the model accounts without thinking about them. Do you want to just cover the fourth one?
Yeah, and just again clarification that teaching assistants are support staff in the staff cost note as opposed to direct staff costs. So again, probably something that's been identified as not being treated that way. So clarification from the SFA there.
Okay, thank you. Shall we write Academy model accounts? Yeah, that's thank you, Fran. I think, as I say, the accounts direction comes out. The changes in direction are mirrored and illustrated in the model accounts. The model accounts are still called Coketown, just as I mean, I thought that was sort of inappropriate joke, but apparently, the English teachers, I'm sure, will know this, but Coketown is in fact the town in Dickens' Hard Times, and it provides an appropriate backdrop to Dickens' withering critique of industrial society, and therefore calling the novel Coketown indicates there's nothing more in the town than the ceaseless industrial activity with all the misery that it generates, which I'm sure is nothing like any of the academy schools that we've got in this school today. However, more relevant, there are few changes, as we said, but they're easy to find because they're all highlighted in yellow. So it's an easy, just mechanically, it's an easy document to use this. Yeah, the one thing we haven't mentioned is the local authority pension liability guarantee, which is important. There was when local authority schools started being transferred into academy schools, there was a question about what happened to the local authority pensions in the event of insolvency or that school stopping trading, and there was a Parliament affirmed a guarantee in 2013. This was reaffirmed in 2022. It doesn't necessarily, and the disclosure in the accounts is updated to reflect that, which I think is reassuring. As people with who have stupid staff out of academies into other organisations, the guarantee doesn't necessarily follow. and once they move out of the sector. Right, on to the last document, the framework and guide. Now, this is primarily, of course, something that auditors read, but it is, I think, useful to everyone because it gives details on common irregularity themes, which is useful, including to trustees and accounting officers, because it's sort of there. But for the grace of God, go I. These are the things that other people hopefully are falling down on. These are the things that you need to concentrate on to give the auditors an easy time, apart from anything else. So, internal financial reporting. What are they saying about that? What's going wrong here?
Yeah, so the requirement to share the management accounts with the board has not been followed, or of poor quality is something they're seeing. Financial management.
What sort of requirements, Mark?
So obviously management accounts are required to be done monthly under the Academies Handbook and shared with the board. What's the update now, Charles? It's every at least
6 times a year.
6 times a year, every other month roughly. So yeah, that's the requirement. So that's not always being followed.
There are specific requirements, aren't there, for profit and loss and cash?
Yeah, so accruals accounting is required, so it can't just be a budget monitoring report, which and
I think people are in the past sometimes, wasn't it?
Yeah, almost inherited from local authority, I suppose, doing the budget monitoring reports. This is something that's getting better, I think, because as academies are getting more mature, but it is still an issue, as ESFA have detailed. Also, just general financial management issues are reported on. So the sort of thing you'd expect to be reported, I suppose, where not confident that there are the correct processes in place for bank reconciliations, control account reconciliations like that, and fail to submit mandated financial returns to ESFA on time. So that's your accounts return, BFRO, land and buildings return, anything that is required. If there's a regular pattern of that not being shown, then it'll show on ESFA's radar there. And then the second point there, again, we mentioned this earlier, related party transactions. So prior approval not always being sought for related party transactions, and the cost policy not being adhered to. Something that I think you'll touch on later with James, Charles, in terms of how things are changing with related party transactions. But again, a big risk in the sector, so is still an issue. So I suppose that's why the rules are stringent, because it's where things can.
And the pecuniary interest, the declarations are of course tricky, aren't they? It's easy to get them wrong. You get them in place at a point in time, internal or external, and they go wrong as soon as something changes if it's not updated.
Exactly.
Okay, and then we'll keep going. I mean, there are also occasional incidents. Fran, can we? Yep.
Yeah, so I think we'll quickly cover these. I suppose these are other things that are showing. The yellow ones being new ones this year. So you've got breach of capital funding terms and conditions. I don't know why I've done that the wrong way around, but failure to ensure competitive tendering processes. So they'll obviously have, for tendering, the school will obviously need to set their tendering process, and the auditors will review whether that's in place. So this has popped up on this list because that's not always happening. And the capital funding, where there is capital funding, there's often terms and conditions. So if that's not been followed in some cases, obviously. The other points are previously listed. So yeah, do you want to go into any detail on that, Giles?
No, I think those are. I mean, I thought, and there's still alcohol. There's still conflicts of interest. Still about making sure that chairs of governors, things aren't approved by chairs of governors when they should be going through whole boards of trustees, etc., etc. So I think that's fine. It's just the slightly interesting new emphasis on competitive tendering and capital funding. Should we have the next slide? Before we finish up on this, there is There is a subtle addition. You'll notice that some of those irregularities that we talked about before were about transactions. So a related party transaction is an approval of a transaction, it's transactional. Making a disclosure of a conflict of an interest on a website is not transactional. And ESFO said the way that auditors deal with irregularities they find has changed subtly. So they're saying if you get a material irregularity and material is what auditors judge whether things are important enough or not, a material irregularity of a financial transaction, this will be a modified conclusion to the accounting officers, the reporting accountant's regularity report. Not the main audit report, so it's in the public accounts. However, a regularity that is either not material or is not in respect of a financial transaction, so it's non-transactional, it goes in the management letter. So the auditors may therefore, and the point about that non-financial transaction, not in respect of a financial transaction is new. This is a new distinction. So you may find that if you've got an irregularity discovered this year, the auditor is more likely not to put it in the irregularity report. However, there is still a judgment. Matters in the irregularity report may be in the findings report, and matters in the findings report may be in the regularity report. So that's not cut and dried. It depends on amplitude and severity, but there is more of an emphasis on the financial transactions going in the regularity report. Can't see any questions. We're now slightly a minute or two overdue, but we're due to move on to exciting topic of leases and electric vehicles with Robin and David. Thank you very much, Mark. As I said, Robin, I'd like another electric vehicle. Can you get me one, please?
I'll sort you one out, Charles. Yeah, it's a bit of a commission involved, but we can talk about that off screen. So, good morning, everyone. From the South Coast, not such a nice day here today, and hopefully a bit nice where you are, David.
Yeah, not too bad, Robin. Yeah, slightly drizzly, but yeah, can't complain.
Okay, so the slides are up. This session's going to cover two interlinked areas that most other academy trusts don't really stray into: company cars and leasing arrangements. I guess there's not many finance professionals working in academy trusts that are familiar with running a company car scheme for their employees, and indeed it's not that many years ago teachers' pay and conditions didn't allow the use of such schemes. Salary sacrifice was available just for things such as childcare vouchers and cycle to work schemes. In terms of leasing, this has usually been limited to things like photocopiers, with other types of leasing often avoided, partly due to the fear of inadvertently entering into a finance lease and therefore potentially an unauthorized borrowing arrangement. The thought of leasing cars for its employees hasn't traditionally been on the radar for the average trust. But in contrast to this, the 2023 Academy Trust Handbook specifically states that ESFA approval isn't required for electric vehicle salary sacrifice schemes, as long as no liability falls on the trust if an employee doesn't fulfill their contractual obligations with the scheme provider. So basically, if the employee were to leave, the trust shouldn't be left with having to fulfill the rest of the lease obligations. So is it something worth looking at for trusts? I think the options become more of a real one at a time when recently hasn't there been a time where we've got the ongoing budgetary pressures. Part of the 6.5% pay award announced in July will be funded by the government, but the trusts still need to find the other 3.5% from existing funds, as they were expected to have budgeted for this sort of increase anyway. Whether this 6.5% award still below inflation levels for the last couple of years, whether that's going to solve the problem of the current teacher shortage remains to be seen, but I think the answer is that it's not going to. On another topic, the past couple of years have seen some very tangible examples of the effects of climate change on our planet. The UK's very hot summer last year wasn't really repeated this year, although we still had some records broken in September. But many parts of Europe have suffered more record temperatures. And we've also recently seen the spectacular and tragic impact of wildfires in a number of the Greek islands and in Hawaii, and only last week the flooding in Libya. So all corporate organisations now, including academy trusts, are being held to account for their contribution to these issues, whether it's through the reporting requirements that are placed upon them, or more prevalently now, from employees and potential employees wanting to know what they're going to do about it to help, or actually what they're doing that's hindering. So over to you, David.
Yeah, next slide, please, Fran. So yeah, thank you, Robin, for that introduction. So the electric vehicle scheme potentially offers several compelling benefits for both employers and employees. And on this slide, we've just noted four good reasons to potentially implement such a scheme. First one on the slide, reducing carbon footprint. EVs help reduce greenhouse gas emissions and minimise environmental impacts of travel. EVs produce zero exhaust pipe emissions, which obviously contributes to cleaner air and a healthier environment. So by promoting the use of electric vehicles, your trust could play a significant role in addressing climate change and contributing to a sustainable future. Improving environmental, social and governance credentials, ESG. It's the next good reason on the slide. ESG considerations have become increasingly important for employers, and adopting an EV scheme showcases your trust commitment to sustainability and responsible employer practices. This can enhance your reputation, attract socially conscious staff, and align your trust with global efforts to combat climate change. And then the third point on there, recruitment and retention. Offering an EV scheme demonstrates your trust's dedication to employee well-being and modern values. Many employees are environmentally conscious and are looking for workplaces that share these values. So providing access to electric vehicles can be an attractive perk for both potential recruits and current employees, therefore enhancing your trust's ability to attract and retain talent potentially. The final point on the slide, cost savings for employees and employer. Electric vehicles tend to have low operational and maintenance costs compared to traditional internal combustion engine vehicles. So by providing an EV scheme, you empower your employees to save on fuel and maintenance expenses. Additionally, offering charging facilities at the workplace can be a cost-effective solution. Electricity is generally cheaper than petrol or diesel. So yeah, incorporating an EV scheme into your trust policies not only aligns with broader sustainability goals, but also offers tangible advantages in terms of the environmental impact, trust reputation, employee satisfaction and cost management. So potentially a win-win situation for all stakeholders.
Yeah, thanks, David. Next slide, please, Fran. Thank you. Yeah, I think there's a number of compelling arguments for trusts to take a look at an electric vehicle scheme for their staff. Just taking a look at the sort of the current environment of EVs at the moment in the UK, and there's been a notable increase in recent years in sales. Looking back to 2018, so 5 years ago, there were 60,000 new EVs sold. That covers both fully electric vehicles, which just run from the battery, and also plug-in hybrid vehicles, which also have a conventional engine that can kick in when it's needed. The mix back in 2018 was roughly a quarter fully electric and 3/4 hybrids. So I think it was about 17,000 fully electric vehicles just 5 years ago. Figures for last year, 2022, there were a total of 369,000 sales. So that's an increase of more than 6 times. And the mix had completely flipped. So 3/4 of those vehicles last year were fully electric, around 267,000 vehicles. With the number of EVs rapidly increasing, we obviously need the infrastructure to improve. That has been constantly improving. As at July 23, so just a couple of months ago, the latest figures I could find, there were 44,000 public charging points in the UK, more than 4 times as many as in 2018. And this, of course, is in addition to the private facilities EV owners may have at their homes or available to them at their places of work. While the time taken to fully charge an EV is still an issue, typically more than an hour, I think it's only really an issue if you're having to undertake a long journey and break up that journey to charge. There's also a number of apps that are getting smarter at making you aware of the availability of chargers on your journey. So I think it's got to be fair to say that the infrastructure is better now than it's ever been, and it's only going to get better as time goes on. Cost of an EV obviously is a key factor. It's coming down, albeit slowly. Around at the moment, the average cost of a non-luxury EV vehicle, so just taking your typical family car, say, is around about £33,000, which is still significantly higher than the equivalent non-electric vehicle, which is around £22,000. And government policy is also a relevant factor in the way the market's moving. One of the headline strategies for the UK, as you probably know, is that after 2030, there'll be a ban on the sale of new petrol or diesel cars unless they have the capability to drive significant distances on zero emissions. And from 2035, all new cars have to be fully zero emission at the tailpipe. So regardless of your views, or you're weighing up the financial cost or benefit, it looks like EV ownership is eventually going to become the only option open to us.
Thanks, Robin. Next slide. Thank you, Brian. So, yeah, if we are considering implementing an EV scheme, just need to consider the 2 different types of leases. So just cover the difference between operating and finance lease on this slide. Schools, I'm sure we're aware, should generally only enter into operating leases. So understanding the main difference between a finance lease and operating lease is essential. An operating lease generally has a shorter duration than the working life of the equipment. Under an operating lease, the leasing company, the lessor, retains risks and rewards of ownership, and it will also retain an investment in the equipment being leased, known as the residual value. And you wouldn't own the equipment at the end of the agreement. Conversely, a finance lease usually runs for all or a substantial proportion of the equipment's estimated working life. Under a finance lease, the lessor transfers the risks and rewards of ownership of the equipment to the lessee. So yeah, the distinction falls that leases that do not meet the operating lease criteria will generally be finance leases. Can be a grey area, and if it's not, if it's not really clear from the outset, looking at those definitions just set out, there are other tests and questions to consider. For example, we might look at, is the lease term for the major part of the economic life of the asset, even if title is not transferred? If the answer to that is yes, probably going to be a finance lease. We might look at the inception of the lease. Does the net present value of the minimum lease payment amount to at least substantially all of the fair value of the leased asset? And again, if the answer to that is yes, looking like a finance lease. Other questions and tests we might look at: if the lessee is entitled to cancel the lease, are the lessor's losses associated with the cancellation borne by the lessee? Again, if the answer to that is yes, it's pointing towards a finance lease. And also, does the lessee have the ability to continue to lease for a secondary period at a rent that is substantially lower than the market rent? And again, if that's coming out, that's a yes answer, pointing towards a finance lease. So yeah, just setting out some of the tests and things we need to consider when determining whether we're entering into a finance or an operating lease. And just at the bottom of the slide here, just put put quite a simple example when looking at a set of computers. If the school, for example, was to lease computers for a period of 3 years, at the end of the lease term, the computers would be returned to the lessor. School would not assume ownership of the computers, and the lease is for non-core equipment, then that's looking like an operating lease. However, if the school was to lease computers for a period of 5 years, at the end of the lease term, the school has the option to purchase the computers for nominal amounts. That would be considered a finance lease because it transfers risks and rewards of ownership to the school. So yeah, just a recap there on operating versus finance leases.
Thanks, David. And I think we can see from that where a typical sort of car lease arrangement, you're looking at a 3 or 4 year lease where you wouldn't expect to be covering the full value of the vehicle or using it for its full useful economic life. So we should generally be looking at operating lease arrangements here. So just to give a case study now on a salary sacrifice arrangement and how it could work for an employee with an electric vehicle. The numbers are quite attractive. All the figures in the example include VAT on the basis that it can't be reclaimed, although it may be wholly or partially recoverable depending on individual circumstances. Also note that the costs may count towards the VAT registration threshold, so you need to take individual advice on this matter. So we're going to look at a nice new Kia Niro. It's a recent addition to the world of EVs and a sensible and practical family car, according to a reviewer found. List price is 36,545. Thanks, Fran, you went a bit too soon then. So not at the bottom of the range, but it's a good option as a family car. And if you want to do 10,000 miles a year, the monthly leasing charge will be around about £520. So I'm going to keep you on your toes now, Frank, because there's a few slides to flick through quickly, but next one, please. So £520 is the salary sacrifice per month. You won't pay income tax on that because you've sacrificed that salary. So a basic rate taxpayer at 20% is going to save £104. They'll also save £62.40 of national insurance. So total saving then there of £166 per month. However, you will have to pay a benefit in kind charge on the company car. The next slide. So the good news is that while the benefit in kind charge is based on the percentage of the list price of the car, which we saw was £36,500, the relevant percentage for electric cars at the moment is only 2%. So the monthly benefit in kind is going to come out at £60.91 per month. That's the benefit in kind. You then pay tax on that at 20% for a basic rate taxpayer. So they're going to pay £12.18 per month in tax. Next slide, please. So the net effect of that, total tax and NIC saved £166. Total tax suffered on the benefit in kind, £12. So a total saving of £154 on your lease cost of £520. That works out at just under 30% of the cost is saved. And as you can see there, the annual savings, £1,850 for the individual. So quite attractive. Next slide. So as the employer, we look at it from the employer's point of view, that £520 of salary that's been sacrificed, you don't have to pay employers NIC on that. There's a saving of £71.76 per month or £861 per annum. Now there will be a cost in administering the car scheme. You'll be paying somebody to run that scheme for you generally, but that should be less than the annual saving. And also you got the benefit of a happier and greener employee, hopefully.
That's great, thanks, Robin. Yeah, the next slide just further highlights the benefit, the better benefit in kind benefit of an electric versus a petrol car. So just following on from Robin's example there. So yeah, the tax charge, the benefit in kind on a company car is calculated as follows. We work out the P11D value by applying a CO2 emission percentage to the car's list price, and we multiply that by the P11D value by the income, by the rate at which you pay income tax, which is likely to be 20 or 40%. So the key thing is the lower emissions rate that are applied to electric vehicles are much more beneficial than petrol or diesel vehicles. In the example below, we can see that a petrol or diesel car can attract a CO2 emission rate of up to 37%. I mean, that's at the extreme, but it can be that high versus an electric vehicle, which is currently just 2%. So yeah, if we look at an example of a car with a list price of £30,000, we can see in the table below the difference in the P11D value and therefore the tax that the employee pays. With a petrol vehicle at the upper end of the CO2 emission rate of 37%, the P11D value would be 11,100. And tax on that at 20% will be 2,200. Tax at 40% will be 4,400, compared to the electric vehicle with a CO2 emission rate of just 2%. P11D value comes right down to 600 quid. Tax on that at 20%, 120 quid. Tax at 40%, 240 quid. So yeah, potentially massive tax savings for the electric vehicle.
There's huge differences there. I think now we've whet your appetite. I think it's time to mention the leasing process. Just a few comments on that. As I say, you'd probably outsource the scheme anyway, but there's a few things to be made aware of. About a year ago, the ESFA published some updated guidance for Academy trusts on leasing. Section 2 of that guidance gives some sound advice on the process. Before you enter into a leasing agreement, make sure you and the employees understand all the costs that are involved. There's the headline monthly figure for the lease cost of the vehicle. Many arrangements also include things like insurance and maintenance as part of the package, but there may be other charges that aren't immediately obvious, such as where you exceed the agreed annual mileage figure. You need to know what that's going to cost you and really just fully understand what you're signing up for. The lease period is also quite important. There may well be a minimum period under the scheme. Our examples were based on a 3-year lease. The employee needs to be happy with the length of lease they're entering into. If, for example, they were planning to start a family in the near future, then entering into a 4-year lease on a mini might not be the right thing for them to do. The contract also needs to be clear on where the burden for paying the monthly cost falls should the employee leave. As I mentioned earlier, this should sit with the employee and not have that burden falling on the trust. Need to know what happens at the end of the lease. Is there an option if the employee wants to extend that lease, to buy the vehicle, or do you just hand it back? That's another area where there could be some surprise costs arising. Lease companies can be really strict on charging for any damage to the vehicle. I know from experience that even some quite superficial damage can be, it's inevitable over a 3 or 4 year period, and they can make quite significant charges for that. And coming back to the maintenance package, how comprehensive is that? Are there things not covered that you and the employee should be aware of up front to avoid any potential excitement or ill feeling later on? Back to you, David.
Yeah, thanks, Robin. Next slide just highlights that there are various grants and incentives available to support the cost and installation of charging points for EVs. Put a couple of examples on there. The EV charge point grant that can provide funding for up to 75% towards the cost of installing EV smart charge points at domestic properties across the UK. And the workplace charging scheme, voucher-based scheme that provides support towards upfront costs of the purchase and installation of EV charge points for eligible businesses, charities and public sector organisations. I've put a link on the slide there for further information. And obviously, anything like this, we need to consider that, you need to consider the practicalities of your particular premises in terms of energy supply and space, etc. So, yeah, a couple of examples of support out there and a link for further information.
Okay, thanks, David. Just wanted to quickly mention some changes that are coming into place. IFRS 16 applies to large organizations at the moment, where operating leases and finance leases, David's talked about the distinction. In the future, for larger organizations, they're going to be treated as the same. So operating leases will sit on the balance sheet the same as finance leases do. Those changes in the rules are going to cascade down to smaller organizations over time. So I think at some point in the future, we will see academy trusts having to undertake to follow these rules. It's unlikely to be something to worry about in the next year or two. And of course, when those changes are coming into play, we will make sure that you're aware of them. So I think just a quick summary.
Yeah, next slide. Thanks, Fran. Yeah, thanks, Robin. So yeah, just to summarise what Robin and I have talked about, the current landscape underpinning the EV scheme and climate change. We've looked at the benefits, potential benefits of an EV scheme. We've recapped on the difference between operating and finance leases. We've given some examples of the tax advantages of electric vehicles, the leasing process, and also some potential grant help out there related to EVs. So yeah, that's mine and Robin's section of the presentation. I don't think there's any questions. So back to Giles. I think that might be covered.
Thank you very much, guys. That's really thought-provoking. I think that the biggest thing, I think that the biggest sentence that came out of that for me was that someone saves a third of the cost on these things. I mean, that's the potential win, isn't it? And it's complicated, and there's bits that you do need to take advice on. For instance, the operating against finance lease, that's an accounting question, so run it past your auditors if you're not sure.
I think the VAT as well, Giles.
Yeah, right. There are VAT potential implications, particularly in an academy that's not VAT registered, that you do need to take advice on. And I just get someone else to look over your tax sums as well. But thank you very much. Thank you very much. We will now go to a break. It's 11:23. We will start again at 12:23, so precisely 10 minutes with the excellent and brilliant Simon Oxenham. Don't be late. That's going to be worth tuning in for. Thank you very much, everyone. Okay, welcome back everyone. The internet clock's saying 11:33. And that was my next question, is Simon with us? Simon's back, coffeed and energetic. We've got 2 more sessions. We're due to finish at 12:30. First session now is our keynote speaker, Simon Oxenham. Simon's Director of Resources at Southend High School for Boys and National Lead on School Finance and Efficiency of the ISBL, which is the professional body for school business leaders. He's also on a thing called Working Group 3, which gives him a huge insight into issues and developments that that are coming up. So over to you, Simon. We're hugely looking forward to this.
Great. Thank you very much for inviting me along this morning. I think actually all of the session speakers today are in fact qualified accountants. And it strikes me that accountants, you need to have 2 things. You need to have grey hairs in order to look distinguished and experienced, and hemorrhoids in order to look concerned. I definitely tick the box on one of those. And looking at the mugshots at the start of this morning's session, I would say I've probably got the most experience. Anyway, first things first, let's think about GDPR and unlock the slide deck. And thanks to Francesca, who's keeping up with me in the background with the slides. So what are we talking about today? So I'm going to have a little look at the brief history of the current funding crisis that we're seeing in schools, look at what we think future funding policy should be, talk about being brave when forecasting at the moment, which is really quite challenging, and just drop a few other sector updates which I think might be useful to you. I will be staying around for the question and answer session, which is about 12:15. So if there are questions, we can take them at the end of this session, or as I say, if you think of something afterwards that you want to talk about, any area of school business leadership is fine. We can do that at the 12:15 session. So pressing on. History. Quick recap. So in the late 80s, we had yuppies and the housing market crash, and we had mobile phones, which were like bricks. I'm sure many of you are too young to remember that, but trust me, they were like bricks. We then moved on, and in the early 2000s, we had the marvels, married and responsible but loaded executives, and you were really going some if you had a phone, a small little phone like is on screen now, with a headset that allows you to listen to the radio while you're on the train. Mid to late 2000s, we then had austerity and multi-year pay freezes. But now we have dinkies and kippers. So dinkies are dual income, no kids yet. And kippers are kids in parents' pockets eroding retirement savings because they can't afford to move out. So the history of funding, I'm going to go back about 10 years just to see what's gone on. So in 2012, the number of factors on the funding formulas were slashed. There was over 100 at that point, and they were slashed down considerably to about 11. In 2013, I did my first long-range forecast, and we were using at that point information from party political conferences. I don't know if you remember the thing called the Education Services Grant, the ESG. That was announced as going at the Conservative Party political conference. So it was really quite challenging doing forecasting then. 2013, the 16 to 19 rate dropped to £4,000 to bring schools in line with the colleges. And that stayed in place till September 2020, which is quite incredible when you think about it. 2014, the Institute started promoting the idea of doing long-range forecasts because you have the ESFA that look after the colleges as well as the schools. The colleges were already doing 3-year forecasts, so why shouldn't we? And we started promoting efficiency ideas. 2015, my institution and some other local schools did a postcard campaign, and we reckon we hit Nicky Morgan, who was Secretary of State at the time, David Cameron, Prime Minister, the school's MP, and constituent MPs of all the parents, with about 36,000 bright yellow postcards saying you need to do something about funding for schools. That then led on to the NFF consultation in 2016. ISBL developed the per pupil cost model of running a school, and for a stereotypical school, for 2015, we reckon the actual cost per pupil was likely to be £4,800. Later in 2016, the NFF came out with a minimum per pupil of 4,600. Already you can see we were on the back foot. 2018, SRMA pilot came out, which I was very heavily involved with. 2019, Boris Johnson announced the 5,000 minimum per pupil. And when we asked the question, what modelling was done, there was no modelling for statistical outliers. We asked, well, so where did the number come from? From his leadership campaign for the Conservative Party. Moving it forward, 2023, we've now got benchmarking, View My Financial Insights. These things start a conversation, but they're not a silver bullet. We've got the RPA, which is a good thing. We've got DFE frameworks, which can be quite useful. We've got the School Resource Management Self-Assessment tool, which we have to do, but there is still no modelling, and we are moving towards a hard national funding formula. So keeping it going, then looking at what other people have been saying about funding over the years. So here's the PAC report from 2016-17, number 49, raised concerns over financial sustainability of schools. Report 57, concerns over capital funding and deteriorating estates. Report 21 from 21-22, concerns over sustainability and distribution. 42, concerns over cost pressures and distribution. And then Ofsted, February 20, concerns over uncertainty of funding, late announcements and cost pressures. And then the NAO report coming in June 23 that said 700,000 pupils are in schools that are unsafe or ageing, just in England. Current funding then. So we've had a decade of squeezing. And CST did a survey at the beginning of the calendar year, published results in March on the 3-year positions for schools. And that said that 20% of trusts were saying they had deficits with options, and 21% had deficits with serious concerns. So that's like a fifth of the sector are saying we are going to be in serious trouble with the way things are going. I just want to highlight what it's like being at the lower end and some of the troubles that causes for those at the lower end of the spectrum, using my own institution's numbers, if that's okay. So the funding floor of 0.5% meant that I've got a £25,000 increase in my funding for this September, plus the MSAG and the TPAG. That equals 3.59% increase in my gag income versus to 8 to 10% inflation and pay rises of 6.5% and whatever the support staff is going to be when that finally lands. We know it's at the fixed 1925 at the moment, but the unions have rejected it and they're currently balloting on strike action. We're seeing suppliers putting out terms and conditions that say we announce CPI plus up to 10%. We know that exercise books just on their own have nearly doubled in the past couple of years. Support staff, that range of 9.22% to 3.88%, because the majority of school support staff will be at the lower end, your actual increase in cost is likely to be around 6-7%. Now, my school's funding is so far below the national funding formula that it's lifted by £252,000 to get to the minimum per pupil. So when you see announcements like 4% increase in deprivation, that would actually result in £8,000 for me. But I wouldn't see anything of it because it reduces the lift of the 252. So it doesn't help. If we then look at additionality, so these are things like additionals in English as an additional language, low prior attainment, deprivation, that sort of stuff. If you had a pupil that ticks every box, that can actually attract £5,275 on top of the basic entitlement. The average basic for Key Stage 3 and 4 is £5,089, and of course pupil premium makes that gap even wider. Just some numerical examples, and bear with me, particularly looking at the section on the right here. If pupil numbers were static and you had the minimum per pupil had been index linked and the post 16 had been index linked, you can see on the right hand column there how much more money we would get per year. And so this just really highlights the problem of not having index linked the minimum per pupil, which was something we called for when we got it introduced back in 2016. So current funding. With the pay announcement, of course, the funding policy unit said on average schools could afford 3.5%. Data from the DfE itself in February said that on average schools are spending 82% of their income on staff costs, and you can see the split there. 80% used to be the acceptable limit, so on average we're already over the previous limit. some numbers on that one. So if school A had 75% of its income being spent on staff costs, and they had a 2% unfunded rise, that would require an 8% reduction in non-pay. There must be some schools that are around about that level. But equally, then if we look at school B is at 84%, so it's above average. A 2% unfunded pay rise requires a 12.5% reduction in non-pay budget. So you can see that there's an awful lot of schools that are going to be unable to afford it. And statistically, if you've got on average schools can afford 3.5%, more can't afford it than can. So the question then is, what happens to the below average? Teachers' pay awards, 6.5%, was fully funded when it was first announced, then it went to properly funded. And if the Secretary of State thinks it is properly funded, then she must clearly also believe in Father Christmas and the Tooth Fairy. Well, let me explain. So you've got the TPAG. I haven't found anyone yet that is actually winning or even fully covering the 3%. So the initial allocation, September to March, so you have to extrapolate it to get the full year. Then the 16 to 19 rate has gone up by basic rate's gone up by 111. So you've got to add that in and compare that to the new allocation. So mine, because I've got a number of elements other than the basic with the 16 to 19 provision, comes in that I'm getting 2.92%, which is about £4,000 shortfall. So the actual teachers' pay award is making things worse. I would need another 93 FSM pupils in order to plug that little gap. And let's go back to the 2 billion, which they keep talking about. When that was announced last autumn, it was to keep teachers teaching in a safe and warm environment and to meet the calls from the sector for additional funding. There'd been an open letter to all the Conservative MPs leading up to the Conservative leadership election. And there was no mention of it funding future pay rises until April 23. Of that 2 billion, 1.45 went into the MSAG. I'm just looking again at some of my costs. So my unfunded teachers' pay rises for 22-23 were 78,000. You can see the support staff unfunded, the energy costs increase since pre-pandemic, the non-pay increase since pre-pandemic. And my MSAG for last year was 71,000, and my MSAG for this year is 171,000. You can quickly see that that's already been spent a couple of times over. So you can't then say it's also for teachers' pay rises. And interestingly, the NFER report came out, said that we would need a 16.5% pay rise to correct it, the real times loss next year on top of the 6.5% this year. So I don't think we're completely clear of strike action. And of course, just worth noting that NSUWT have reserved the right to strike with workload. 13% of schools weren't doing tutoring in 22-23. I had mentioned at the Academies show in April that a lot more schools are pulling out for this year. All of a sudden, we then get an announcement that 50% of the costs are being funded this year. We're also seeing teaching retirements getting earlier and earlier. We're seeing it down as low as 52 now. If you look at the tests, at the jobs, that gives you a fair indication of what's going on. So 24th of May, so this was 3 days before the deadline for handing in your notice, there were 11,822 teaching vacancies on the test website for September. That equates to nearly 50% of all the schools in England having a teaching vacancy for September that they hadn't been able to fill 3 days before the deadline. So there very much is a teacher recruitment crisis out there. Of course, we've still got heat gates and ventilation battles, people running around closing windows, opening windows, and having the heating on and off and all the rest of it. That's all still going on. 30% contribution to SIF is pretty much unaffordable now, which makes the whole maintaining your estate a lot more challenging. One of the questions that I'd ask is it right that we have to make health and safety decisions based upon running out of cash versus the risk of a fine or prosecution? And this is a large pothole at the back of my site, which we've decided we were going to have filled because it was getting so big, because it was likely to damage someone's car or somebody was going to come off their bike or something. But just a really good example of what I mean by that. Current funding, there's the report that the BBC picked up on, that link there, which is really just saying how bad things are with the chronic underfunding of the school estates. Interestingly, the DfE, even with the rat crisis, keep putting out this blog Proofreading might have helped because their article, their blog says schools are being designed in the rebuild program to withstand 20 or 40 degrees increase in heat. I think that would be 2 and 4. Then there's the staggering competence article there. That's about the Caledonian modular buildings that where they're building them off-site, and that company's gone bust. And some of those school buildings are actually having to be demolished even before they've been occupied. So RAC and GEMS, 174 schools as of this morning have got RAC. I very much want you to pay attention to this little bit because this is quite important. Look at the accounts direction and look at the model accounts, particularly the regularity statement. The guidance says it must include the following text, and this is about confirming the accounting officer signing to say that they are compliant with good estates management for schools and all aspects of health and safety. It doesn't say you can't add to it. So I've agreed with my auditors to put a comma as far as funding permits, because what that is about of blame avoidance, and that's the DfE worried about a headline which says school ceiling collapses, school blames DfE for lack of funding, and that really is the truth of it. Schools rebuilding program, let's have a little look at that one. 50 schools a year, and according to the DfE website, you've got 24,400 schools. Not sure why they keep talking about 22, because their website says 24,400. If you rebuild 50 a year, that would mean it would take 488 years to rebuild every school in the land. 2 questions. How many schools do you know that are 488 years old and still in operation? Second question, how many school buildings do we know of that were built in the last decade, say, that were designed to last more than 50 to 75 years? If you rebuilt 100 schools a year, it would take 244 years. Jonathan Slater, you may have seen as part of the RAC crisis, said that he'd gone in and asked for 200 schools. Would that have meant 122 years? 300 schools a year, 81 years. And you can see we're starting to get a bit more realistic. But that really, really is highlighting to us how far short the capital funding actually is. Is the Secretary of State doing an effing good job? Well, there is some speculation as to whether this RAC crisis is incompetence, or in actual fact is a very, very shrewd political move, because she's so struggled to get money out of Treasury. Because if you wanted to get education funding high up on the election manifestos, you need a crisis in schools. So you light a bonfire and call it RAC. Is the PM to blame for RAC? Probably not. It's successive governments. However, he probably can't feel too smug, because it was him that took it down from 100 schools to 50 schools. Current funding, Laura Kunsberg observed that when she was doing her interview with the Ofsted Chief Inspector, Amanda Spillman, that there's lots of money and lots of praise going into the NHS. But in fact, whilst 1 million people have some kind of contact in the UK with the health service every day, there are 9 million pupils go to school every morning, and that's just in England. So I think school funding is starting to move up the agenda now. Keeping going with the current funding, politicians will say, well, the schools are getting more than ever. Yes, but what are we doing that's additional? We've got the journey to the cloud and all of the things that entails. We've got the Gatsby benchmarks, where we have to do a lot more with careers now. We've got mental health and counselling teams on site, more than we've ever had before. We're even being able to do food voucher distribution for the local authorities, which we don't get paid for. Safeguarding has become such a thing that we've probably all got a database and probably somebody looking after it for safeguarding. And of course, you've got the sustainability agenda coming through for 2025, and we look forward to seeing what that guidance is going to be like when it's due to come out in December this year. Things like we've all got defibrillators. Well, that's great, but it's another cost because we've got to maintain it, we've got to have people trained on it, etc., etc. So the more just continues to grow. And the amount of compliance that we're having to do now just continues to grow and grow and grow. So in my role, we're very much, I think, living in fear of non-compliance. What is it that we've missed? So in summary then, I think we've got very much a crumbling school system. The 2 big issues though, teachers' pay, linked to retention and recruitment, and then the long-term financial viability of schools. So what do we think needs to be the future for funding policy? Sufficiency, future confidence and capital. Quite simple, just three things. Let's dig into that a little bit. Sufficiency. People say we don't have a choice. So the G7, looking at the percentage of GDP that they've spent on education, Canada, 5.5, France, USA, Germany, United Kingdom down at 3.9, then Italy and Japan. So we're quite low down. Well, the average is 4.6%. To give you what that might look like in real numbers, if we had 4.6% compared to 3.9, from my school, that would be an additional £1.4 million of operating income. And life would be a whole lot easier. That's all data you can get from Wikipedia. So let's have a look at some other comparisons going in that vein. You can see them popping up on screen now, right the way down to Norway at 8%. So UK is actually 3.9%, is 114th out of 192 countries with published data. And this is from 1989 right through to 2019. So quite a significant period of time. So an average of 5%, that would give me a £2.2 million of operating income extra. So clearly we do have a choice. So what we're suggesting is that you should be aiming to be at 5% of GDP / the top third. You know, when you think that other countries like Ethiopia are putting in significantly more than we are, Houston, we have a problem. Future confidence. We've been in the squeeze for 10 years. It's been going on for long enough, and eventually you get to the point where you're not just cutting the fat, you're cutting into the bone. And I don't know about you, but I spend vast amounts of time talking about funding and finances with senior leadership team and with the trust board. We really want a clear funding policy for future generations, for both mainstream schools and for special schools. So the quite simple answer is we need to find a way to lock it in, i.e. lock it into CPI, link it to CPI. Capital. We need to recognise that pupil environments that they're in influences their outcomes. Their behaviour is influenced by the environment as well. And the risk of failure, as we've seen with RAC, is very much growing in the school estate at the moment. And we think the pupils deserve better. The quote that I came up with, the evidence is clear, the school estate is not funded adequately, and the upfront cost to fixing it is growing to be a seismic problem that we seem to be content to inflict upon the next generation. My fear is what they might inflict upon us when they realise we're in a care home. Now, if you think I'm being a bit glib, my daughter is in one of the schools that's closed because of RAC, and her school was closed at the end of May half term, and currently we're looking at possibly November to get some demountables. So for capital, we think 25/75. There should be sufficient capital that you can refurbish a classroom every 25 years. I think you need to have sufficient capital to rebuild a school every 75 years. Because as you think about it, how old your school buildings are, probably at 75 years, they'll be done. So, forecasting in turbulent times or being brave. Some things to ask yourselves. Pupil outcomes should be number one in every decision that you make. So can you demonstrate that you're as efficient as you can be? Have you explored every option? Are you forecast based on realistic assumptions? Do you have a predicted outturn so you know where you're going in the current year? Are all your decisions defensible? If every kid has got an iPad and you haven't got enough money to buy print sticks, that's possibly an undefensible decision, for example. Have you had an SRMA visit? I had one last year that we were invited to take, so we said yes, and I called in the godfather of SRMAs, Mr. Andy Hamilton, and that was highly entertaining. Are your parents ready to be supportive? Have you got your MP road up? If you can answer yes to all of those questions, then I think you need to start thinking about protecting your provision and being brave. And being brave means contacting the ESFA and engaging with them. Just something to point out that when they first started doing long-range forecasts, the BFR, the sector had pessimism bias as far as the IFE were concerned. And what that meant was that everybody was putting in their forecast saying we're heading over the hill, but nobody ever did. Now we're seeing optimism bias with people saying no, it will be fine in their forecast in order to avoid one of those pesky SRMA visits. Be sensible. Be realistic is my advice, please. Something else to be aware of, and apologies for a slight merchant of gloom here, pupil numbers. This is from the IFS. They are saying that pupil numbers are going to be falling. There's the sectors, and there's the more regional distribution. So it's particularly in the North East, South East London that are going to be affected. DfE guidance on what to do is there. Talking to people, there are lots of trusts that can't make 23-24 work. There are lots more that can't make next year work. So if you've answered yes to all those questions on the previous slide, then think about being brave. Don't accept that it's a failure of the board, poor management, if it is actually a failure of national funding policy. Just remember, pupil outcomes must be the priority in all the decisions. This is the web page for the 40 million hardship fund that was announced with the teachers' pay. As you can see, that's particularly helpful at the moment. Now, I don't know what being brave looks like for you. I can tell you that today I am talking to you from my room in Westminster. Sanctuary Buildings is next door. And after I finish with you, good folk, today, I'm going to go and have an entertaining meeting with the schools minister, talking about the financial plight of my institution and of the sector. So being brave, worst case scenario, head teacher / CEO gets suspended and you get an interim board put in place. But remember the Daily Mail test. Officials live by the Daily Mail test, i.e. avoiding being the next headline. Better case scenario, you get additional funding. But just consider any conditions if they drop those on you. Best case scenario, if we all stand up and be brave and say, we can't make this work, we've got to have more funding, the whole sector gets additional funding. This is just as an example now on screen of how I model options for meetings, various scenarios. You can move those sliders around and change things. How do I do that? The instructions are on the next slide. It's native Excel. That's a free takeaway for you. One of the things, though, to be aware of when you do engage with officials and ministers is the unpalatable decision tension. And what I mean by that is that ministers will say things like, in secondary schools, you should have 3 modern foreign languages, you should have a library, but junior officials will be saying, well, if you need to close the library and reduce your curriculum, then that's what you need to do. Again, think about pupil outcomes and what's best for the pupils and stand your ground. Are MATs the answer? I don't think so. What we're seeing is that MATs are moving money around within their schools in order to avoid deficits. There's still no evidence that the economies of being part of a MAT outweigh the diseconomies. I think you've got the FE pay cap that's come in. I can only but think that they're going to bring that some way into the academy sector. With the FE pay cap, anyone that you want to pay more than £150,000 to, you have to get ministerial written permission and allow 2 months to get that. So I think there's going to be lots of reasons why MATs are going to struggle. Other bits of information, DfE did a survey of head teachers back in June. They are going to publish that information. We've managed to track the author down later this autumn. There's a reserves guide coming out. Treasury is still very much fixated on them. Suggested numbers could be 5% would be the lowest, 20% of operating income being the highest for your reserves. Board diversity, most have avoided that because of the legal implications, where you should publish those. SIF outcomes, was the feedback correct? And watch out for fire doors. Lots of fire risk assessors saying you need a specialist fire door survey. The fire door survey is done by companies that supply fire doors. Fire doors, relatively low risk with schools because you're going to be out of the building in about 3 to 4 minutes, and most aren't residential. Why spend money on fire doors if you don't really need to? Handbook, simplification or complication. ICFP is now in as encouraged. ICT, the DfE ICT standards are likely to go in, we're told. Sustainability, that will probably go into the handbook in the future. But the notice to improves, they are still trying to be more carrot and less stick at the moment. Internal audit, I can see that as an area that's going to continue to grow. There's an updated good practice guide coming. Sustainability, I think you'll end up having that audited. That's the same with ICT, ICFP, health and safety, probably already getting audited, and GEMS. And think about how you combine a summary report, whether you want to perhaps get your internal auditor to take, say, your health and safety auditor's report and combine them to the summary rather than getting a committee to do it. So in conclusion then, as I bring it into land, be brave, produce realistic forecasts, be ready to prove efficiency and protect the provision. Be ready, think about election manifestos, how we might influence those. Think about the 3 pillars, the sufficiency, the future, confidence and the capital, and be ready for them all. And be committed to standing up for yourselves and the pupils that we represent. So with a cooked breakfast, they say that the chicken participates, the chef is involved, but the pig is committed. How committed are you this morning? Finally, the event organisers asked me just to say that they would very much welcome feedback on all the sessions this morning, both negative and positive. If you have any negative feedback about this session, then my name's Gillian Keegan, Secretary of State for Education. Thank you very much. Good luck.
Well done, Simon. Thank you very much. That's an effing good job you've done there, undoubtedly. Can I ask you a question? This is what happens after the next election?
So what we are quietly working on in the background is the possibility of doing a national funding campaign with inviting all schools and trusts to participate, because we need to get education funding high up on the election manifesto. We think RAC has helped, but we think we can do more to get that high up. And what we want to do is approach all political parties, all party political candidates, to get them all focused on it, so that they then start bidding as to how much that they're going to put, how much they would invest, because that's really the only way to do it, we think. Because
You've
as you've seen
answered
from the numbers I've shared with you,
and I asked,
yeah,
what should we do? Yeah, what should we do before the election rather than what should happen afterwards? Absolutely. Thank you very much.
So
yeah,
I'm hoping that we've already spoken. We've got one of the big unions involved, two of the big unions involved, and the institute. So there's a couple of others we need to have conversations with, and then we're thinking about something a bit like the postcard campaign, but doing it on a national scale. So watch this space.
thank you. Thanks very much. Okay, we'll come on. Well, okay, so we'll move on to the next talk, and then we've got time. I think we may have time at the end. We'll move on to some questions. Okay, next section. James, Academy Trust Handbook and Managing Risk. We know, right, okay, James, the 2023 Academies Trust Handbook was released during the summer and it comes into force 1st of September, start of this month. Is there anything major we need to know about?
Yeah, thanks, Giles. I think the latest iteration of the handbook is really interesting, in so much there seems to have been a tide change between towards reducing the regulation. So, since I started working with academies over the last decade, we've seen each iteration of the handbook sort of add extra layers of additional rules each year, making academy administration increasingly cumbersome. Last year, 2022, the enhancements seemed to be very minor, and it felt much more like a holding position. But for 2023, there are small but notable movements towards a relaxation of the guidance.
Yeah, I think tide change is a nice way of putting it. Can you say a little bit more?
Sure. Okay, so the main change is really about relaxing the rules in relation to administering related party transactions. Next slide, please, Fran. So, over the years, there have been some fairly embarrassing public scandals. You may have seen this news article in relation to the Perry Beaches Academy Trust, who was given a notice to improve in 2016, following the revelation that the chief executive was paid an additional six-figure salary through a related party arrangement. Now, on the back of these sort of embarrassing headlines, the ESFA has been steadily ratcheting up control in this area. And as things stand, the regulations are currently some of the most onerous of all of my not-for-profit clients. So, for instance, registered charities have a much simpler set of rules to follow. Now, as news stories such as Perry Beaches scandals have started to abate, it seems like the ESFA are feeling comfortable to take its foot off the pedal a little bit. Now, as everyone's probably aware, one of the historic rules is that if you transact more than £20,000 with a related party, you're required to get prior ESFA approval. Now, one of the major changes is that this threshold has now doubled to £40,000. Furthermore, this threshold only applies to individual contracts, and so there's no requirement to look at the cumulative purchases that are building up from a related party.
Yeah, and that's that's important, isn't it? Because before it was always cumulative. Once you're over the limit, everything needed prior approval, didn't it? And now you can just look at things, transactions individually.
Absolutely. So it does help to simplify things.
Yeah.
As well as the relaxation on the value of these transactions, there's also a relaxation in relation to the type of transaction that need prior approval. So purchase from schools, colleges and universities, which are the Academies trust sponsors, and from any state-funded school or college, including other academies, no longer require prior approval. However, it is important to point out that this relaxation would not apply to a trading subsidiary of such a party. And this relaxation doesn't apply to purchases from an Academy's own subsidiary either.
So just on that, the subsidiary point is because coming from fear of events like Perry breaches, they still see as a transaction with a subsidiary. The rules still treat a transaction with a subsidiary as a movement of funds out of the sector, out of control, don't they? They still treat them as a risk.
Absolutely. I mean, subsidiaries are a strange phenomena. I mean, they were sort of set up in the charity sector as a mechanism to kind of not pay corporation tax, and they are sort of set up in this arm's length basis, even though you kind of control them because you have all the share capital. So yeah, I think they still feel a bit nervous around that kind of arrangement. And
one would hope that that would be a next stage in deregulation, would be to shift onto subs, wouldn't we?
I think it would make sense. I agree, Giles. It's also probably worth mentioning that these approval requirements don't apply to religious trusts, where they are purchasing essential functions fundamental to their religious character and ethos that can only be provided by their religious authority. So just to be clear, that doesn't sort of give them a blanket relaxation from all purchases from diocese, but just for the fundamental things you need to get in for the religious character of the school. So, you know, other purchases would still fall within the related party rules.
Yeah, that's well, because I know we've got Diocesan and Trust represented on this listening today. It's not handbrake's totally off. It's just those that narrow class of transaction. Right. Anything else that's relaxed, James?
Absolutely. Okay, so you may remember that where a contract takes the trust's cumulative annual total with a related party beyond £2,500, the element above that figure should be at no more than cost. And there's sort of provision in the guidance about, you know, having a contract where you can sort of go and look at their books and records and confirm that's the case. And it's sort of quite messy, really. And I'm pleased to report that that rule again has been removed from purchases from a college, university or school, which is the Academy's sponsor, or again from any other state-funded school or college. As I previously mentioned, this doesn't apply to subsidiaries, or indeed the trust's own subsidiary. All related party contracts must, and agreements still must be reported to the SFA in advance of commencement or renewal.
Yeah, so at that point, purchases from another Academy trust, you no longer have the at cost requirement, which will free up a number of those transactions. But again, not all handbrakes are released. All of these things still have to be reported to ESFA in advance. Yeah, so we've got three types of requirements. We've got at cost, prior permission, reporting to ESFA, and everything still needs to be reported to ESFA. Yeah,
spot on.
Okay. So that seems to have done related party relaxations, which we're very keen on. What else?
Okay, there are some further relaxations in the handbook, although in my view, these are less exciting. So first of all, the requirement to share the management accounts with the board 6 times a year has been removed. Although in practice, I think this is actually quite a minor concession, as the requirements to prepare management accounts and share them with the chair still remain.
And that's monthly, isn't it? That's monthly.
Yeah, absolutely. Six times a year. Yeah, so you're right. The
remaining
share with the chair is monthly. Yeah, absolutely right. As discussed by our colleagues earlier, there are also some provisions that allow trusts to set up salary sacrifice schemes for electric vehicles, which I think is quite exciting, without getting prior SFA approval. as was mentioned earlier, that the main provision here is that you ensure there is no liability falling back on the trust for non-payment. There is also no need now to report the reasons in your accounts if fewer than 6 board meetings took place in the year, but there's still a requirement to hold at least 3. That's still in place. And actually, there's been a very minor relaxation on the budget setting process, allowing an extra month to submit the annual budget forecast return.
What you haven't said, Jay, I mean, people remember last year, we put out newsletters in the spring saying we're going to get relaxation on certain finance leases, didn't we? And then it was taken out when the trust handbook was published at the end of August. How's that come in?
Yeah, absolutely. So I think we were all sort of expecting it to be released, and actually it just didn't make it to the 2023 trust handbook. This issue seems to be rumbling around for a couple of years now, and at this stage there's no indications that the potential relaxation will make it into the next iteration.
Yeah, and I think those people who are involved in colleges, there's interesting changes. I think if you look across the colleges, you don't necessarily you can't predict the future. Colleges have been reclassified to be more akin to a status like academies, but they don't have the finance lease problem.
Okay.
But what can we learn from this? Probably nothing. Right, but it's all pretty positive. Are we going in the right direction?
Yeah, no, it does seem like a step in the right direction, Giles. But actually, I think for many of us working in the sector, it does feel like further relaxations would be welcome. As an academy auditor, I think I often find myself having to consider activities that might feel actually quite immaterial in their nature.
Yeah, go on, give us some examples.
Okay, well, I don't want to sort of reignite old debates, Giles, but I think the SFA zero tolerance on alcohol purchases feels pretty heavy-handed. I mean, I'm not condoning that large swathes of government funding are used for lavish parties, but the odd bottle of wine as a way to show appreciation to the sector feels actually like quite a proportional purchase. We've touched on it before, areas such as photocopier leases and whether they fall under the wider ban on finance leases is another area where I think the rules are disproportionate. So in short, I think it would be more efficient use of everyone's time and money if the guidance continues in this trajectory and becomes more pragmatic in a number of areas. It's also probably worth mentioning that not all the changes in the handbook were relaxations. There were also a number of clarifications as well, as highlighting areas of additional emphasis.
Okay, we need to know what these are, James.
Absolutely. Okay, it's a good question. Some of the clarifications are relatively routine. For instance, it's made clear that the accounting officer and chief financial officer shouldn't be the same person. There's also, interestingly, a gentle nudge towards implementing gag pooling, making it clear that the SFE sees that as potentially a valuable approach.
Yeah, and there's some multi-academy trusts who haven't yet considered this, so this should be of interest to them.
Yeah, absolutely. Although interestingly, the handbook still insists there should be an appeals process and that disputes over allocations can still be escalated to the SFA. And I think sort of when I speak to multi-academy trusts that I work with, a lot of them sort of feel that's a bit of a barrier. There's an anxiety that if they did gag pooling, it might end up having long, protracted sort of disputes with individual schools, which just sort of slow down the whole process. So I still think maybe there's more they could do to try and smooth the way to introduce gag pooling more across the board.
Okay, so let's check. I mean, a theme of today has been around RAC. What else? What's in the trust handbook is relevant to RAC?
Yeah, that's a really interesting question, Giles. If you looked at the 2022 handbook, there was a reference to good estate management for schools handbook. But in 2023, the supporting advice has proliferated to include things like condition data collection, school capital funding guidance, and interestingly, as well as the reinforced autoclave aerated concrete RAC guidance.
Where perhaps the horse has bolted?
Yeah, I agree. It's interestingly, the list of areas where notice to improve may be issued has also been included. And this includes a number of governance issues, such as failing to comply with safeguarding duties, or simply lacking the skills, knowledge, or experience to exercise effective oversight.
So this is one of the things that Simon said, was that you have, in running a school, you have a fear of an ever-growing number of compliance risks, and which encourages me, as someone who designs presentations to academies, that where we're talking about risk and we're talking about things compliance, but we're in an ever more turbulent environment. Do you have any advice on how trustees we are planning to talk, you're planning to talk a bit more about risk management, I think.
Yeah, absolutely. So I agree with you, Giles. I think, if you look at the world at the moment, we've got RAC, volatile energy prices, unrest with teaching unions, and it feels like there's a lot of risk plates spinning that trusts need to keep their eye on. And in my experience, actually, most trusts build their risk management strategy around risk registers. And, risk registers have been around for a long time. They're well understood mechanisms for articulating risks and how they're being managed. And Fran, if you go to the next slide, they may look a little like this. So, this is a very sort of simplified example. There's only one risk on here, but basically, risk registers work by assigning a perceived risk a score both before and after some form of mitigating activities in place. So in this example, we've picked up RAC. So the school said it's a major risk. It's likely to happen at the high impact. They've then gone off, got some advice from surveyors, have actually said, well, no, we think the risk of it actually happening is much lower, and the score comes down accordingly.
This is a model. This is the kind of table what most of us are familiar with. It comes out of a table. It sort of ultimately derives from piece of guidance from the Charity Commission some years ago, doesn't it? I think this is a really interesting example, because I suspect that there are schools that have RAC that probably had this on their risk registers and assessed it and thought it was all managed, and as you all know, the issue has exploded over the summer. Do you think that affected schools? Well, do you think affected schools should have done more, or should be doing more?
Yeah, I'm not professing to have been able to have foreseen the whole RAC issue. And from what I understand, the risk crystallised over the summer because in a particular school there were some beams previously considered to be robust and they unexpectedly collapsed. Well, you can be a bit more cynical I think Simon was suggesting maybe there's other things going on, but on the face of it, there was an unforeseen event which has kind of triggered this. But saying that, I do wonder whether taking a more holistic approach to risk management might have raised it on the agenda, or at least raised things like business continuity planning, which is effectively the situation these schools are now sort of facing.
Yeah, what do you mean?
Okay, so I think risk registers are the standard go-to approach, but they can be quite voluminous, so you get lots and lots of risks in there. And I think what happens very often is risk managers feel like they've absolved themselves a little bit when they escalate the matter to the board. So I think there's an emphasis to kind of score things quite highly. And so by the time trustees get to see the risk registers, there is just too many risks on there sort of to meaningfully have a discussion at board level. Another problem I often see is that maybe one or two individuals take responsibility for the risk register, and they kind of are sitting a little bit in an ivory tower. And so without input from other key individuals, you kind of get this sort of rather narrow view of what the risks are.
Yeah, you and I will have been in, I'm sure you've been in meetings like I have, where there's a lot of very interesting practical operational issues, and you get towards lowish, sort of about 3/4 of the way through the agenda, and then the review of risk registers, and it's sort of brief or superficial, or doesn't necessarily achieve anything. I'm just being devil's advocate here.
No, I think you're spot on, Giles. I've been in trustee meetings myself as a trustee, and I know you get towards the end of the meeting and you're suddenly faced with this matrix of risks and scores, and very often people are exhausted and they don't really give it the time and energy.
And so therefore, how do we bring it to life?
Okay, so I'm a big proponent of the idea of risk mapping as a way to better understand how risks are managed within an organisation.
Yeah.
So I think to better explain this, it's important to try and explain what the 4 lines of defence are, and Fran's kind of put that up on the slide. So this idea of 4 lines of defence is a model of risk management, which basically says within any organisation you have 4 levels at which risk is managed. On the ground defences are controlled day to day at an operational level. So the assurance is coming from those who are embedded in the process. It does lack independence, but it is delivered by those who know and understand the organisation at a detailed level. Oversight then is a second layer that encompasses how the organisation oversees this process and makes sure that it's operating effectively. So this could encompass things like reviewing the risk registers, discussions at board level. Independent assurance covers activities such as internal audit. So this can look at overall effectiveness at a governance level, as well as the robustness of risk management controls. And then external insurance is anything else provided by external bodies. A good example being an external auditor. Although arguably these people are more detached from the process, they can often have useful insights on how things can be developed.
Yeah, and there's nothing like being able to see this in practice, is there? Can you show us the next slide, Fran, where we've got an example?
Yeah, so this is a really simplified example, Giles. So I think we've, the risk areas we've made very high level, but the idea here is that in the columns we've got, a couple of first line defence controls. We've got, second, third, and fourth, and we've kind of RAG rated it as to whether, which lines of defence are offering us, high, medium, or low assurance in particular areas. So, if you were faced with a risk map that looked like this, you might look at the human resource line and say, well, crikey, there's an awful lot of red and amber there. So perhaps we need to put a bit more energy into looking around human resource. So potentially you might go to your internal auditors and say, can you do a review in this area? Similarly, if you look on this example, finance, we've got lots of red in the second line of defence. So again, that might precipitate a discussion at board level about what this means in practice and whether action was needed to boost skills or resource at this particular level.
Yeah, and I think you don't, a school or an academy doesn't have to do these themselves. They might be able to, they just might not have time, and they can ask their internal auditors or someone else. We're currently helping an HE institution with constructing, and from our point of view, it's a fairly mechanical exercise. We're going around, we're doing the legwork, putting it together, and then when with the final product, they will then make the assessment of how well things are, particular risks around 13 headings are being covered. So I think it's a good exercise. But the point is, it's for the purpose of the audit committee, to help them to be assured that, because not everywhere needs an internal audit, does it?
Exactly, and my perception is that the interface between internal auditors and trusts is a bit weak at the moment, and the handbook does require trustees to feed into the process. And if the internal auditors produce a map like this, or it's produced internally, I think is a really good first step in trying to steer the best places internal audit resource needs to go.
Yeah, and it's Is there anything else you just want, before we wind up, you want to say on risk management, James, or do you think we've covered it?
Absolutely. I think we're running out of time a little bit, Charles, but I think another key thing I like to see is bringing on the ground risk managers to audit and risk committees and discuss their thoughts and concerns. Done the right way, it can be really supportive, and it starts to get this message out to the wider staff body that opening up discussions throughout the organisation and making risk a live topic. I think that things like that can really sort of articulate or help articulate what the organisation's appetite for risk is, and also its strategic approach. But the key message I get across, though, is whatever tools you use, trying to create a holistic culture of risk management is likely to be more useful than focusing heavily on the risk register.
Yeah, thank you. I think that's very, I mean, that's good practical advice. The number of requirements are increasing, despite the fact that we've got a tidal change that you brought out, and I think this is a good way for complicated organisations to be rethinking. Thank you. Before we wind up, there is one question. There is a question that I think we do need to ask that is raised that needs to be put, and it's to Simon. If Simon's here, you mentioned that there's work being done on reserves guidance. Is that something that you can say more on?
Yes, so there, it's in the suite of good practice guides. It hasn't been published yet because I'm part of the working group 3. I've seen the draft of it, and there's a number of us from working group 3 that then gave responses back. So it is coming. It is coming. When it's going to come, don't know. I have seen the sort of the approved draft that's gone for ministerial approval of the internal audit scrutiny document, good practice guide. So that one will come out fairly soon. Don't know when the reserves one is going to come, but it is definitely coming. It's in train.
And without putting on the spot, Simon, what's your view on the 5% to 20% levels which have been bandied around to start it off?
If you think about the COVID workforce support grants, they were saying that if your income was below, if your reserves were less than 4% of income, or 4% or less of your annual income, then you were eligible. So it wouldn't surprise me if they did say 5%. And 20%, I think, is possible. It depends if you're saving up for major capital works. But the risk is that there's going to be quite a lot of us that are going to be below that below the 5%, and what that's going to do with the interesting conversations that we might have with our audit partners this autumn.
Yeah, I'm sure. Yes, I'm sure. I've certainly got one or two as well who are below that level.
Okay, right. Well, thank you. We will. I will wind up now. Thank you very much to all the speakers, and in particular to Simon. All the speakers, I understand, would welcome email questions afterwards. We will be for PowerPoint. If you wish for a PowerPoint, a link to the presentation, could you just email us afterwards? We'd be happy to share. Finally, I hope that we've been interesting. I hope we've been thought-provoking, and I hope we give you with practical actions to go away, and in Simon's word, give you the confidence to be bold. So have a good day, everyone. Thank you very
Charles,
much.
It's just Fran here in technical. So just to let everyone know, by this time tomorrow, an email will be sent to all attendees with a link to the PowerPoint and a link to the recording. Try and get it done this afternoon, but if not, it'll definitely be by tomorrow.
I'm sure tomorrow's fine, Fran. Yeah. Thank you very much. Bye, everyone. Till next year.